Hello and welcome to the UK Mortgage Market Insights for the week ending Friday the 15th of May 2026. I'm Craig and as always I'm here to cut through the noise and give you a clear picture of what's actually happening in the mortgage and property market this week. If you find this useful, please do hit subscribe. It really does help to get this content out to more people who need to see it. Now before we get into the usual weekly roundup, I want to flag that this week Halifax have launched a brand new mortgage product aimed specifically at first-time buyers, and it's caught a lot of attention. So at the end of today's video, I've put together a special section covering that product and all of the other main schemes and products currently available for first-time buyers and anyone who is really serious about getting onto the housing ladder. So if that's you, make sure you stick around for that, and if you know someone in that position, please share this video with them. Right, we've got quite a lot to get through, so let's get into it. Now, before we get to lender rates, I want to set the scene a little, because what's happening in the background really matters right now. The Middle East conflict has been slightly quieter this week in terms of headlines. Perhaps that's because Donald Trump has been on a publicity mission to China. But as you know, markets don't like uncertainty, and there's a new source of drama closer to home. The political situation surrounding Keir Starmer and the fallout within the Labour Party has been unsettling gilt markets. The 10-year gilt yield was sitting at 5.02% last night. That's elevated, and it matters because gilt yields feed directly into swap rates, which is ultimately what lenders use to price their fixed-rate mortgages. Swap rates have moved up this week. The 2-year swap closed last Thursday at 4.141 and the 5-year at 4.142. This week, they're sitting at 4.245 on the 2-year and 4.253 on the 5-year. That's roughly a 10 basis point rise across the board in a single week. So keep that in mind as we look at lender movements, because some lenders are still cutting rates marginally, and they're doing so against a backdrop of rising funding costs. I'm here to tell you that that won't last indefinitely. So let's go through what the lenders have been up to this week. Nationwide have made the biggest move, reductions of up to 0.36% across the board. That's a significant cut and puts them in a very competitive position right now. Virgin Money are also cutting with reductions of up to 0.26%. on both purchase and remortgage products. Good news if you're buying or looking to switch. TSB have reduced rates across both purchase and remortgage too, and the Mortgage Works, which is Nationwide's buy-to-let arm, have cut by up to 0.2%, so landlords, that's worth keeping an eye on. Bank of Ireland are reducing rates as well, adding to the general downward pressure from lenders this week, and NatWest are a slightly mixed picture. Some rates down, some up, and in particular their existing customer rates have seen some increases. So if you're a NatWest customer coming to the end of a deal, please don't just accept whatever they send you. Get advice, because there might be better options elsewhere. So looking at economic data, yesterday we got the latest GDP figures, and on the face of it, they look positive. The UK economy grew by 0.6% in the 3 months to March 26, and monthly GDP in March came in at 0.3%. Services up, construction bouncing back after 5 consecutive months of falls, and if you just read the headline number, you'd think that everything was rosy. But I urge a bit of caution here. A lot of that growth was front-loaded. Businesses and consumers were rushing to get ahead of the tariff uncertainty earlier in the year, pulling activity forward into Q1, and that distorts the picture. The question isn't what happened in January to March, it's what happens next. And there are real reasons to be cautious about the rest of 2026. The IMF has already flagged that the UK is looking at some of the worst growth forecasts among developed economies this year. With projections pointing towards 1% growth for the full year, that's a significant gap between where we are now and where we're headed. If activity was pulled forward into Q1, the remaining quarters in the year could look considerably softer. Add to that the ongoing pressure from elevated gilt yields, the uncertainty coming out of Downing Street, and the lingering drag from global tensions, and yesterday's numbers start to look less like a turning point and more like a temporary bright spot. Good news is good news, and I won't dismiss it, but don't let one strong quarter change your planning. The broader picture is still uncertain, and that matters when you're making long-term financial decisions like taking on a mortgage. Now, I've been saying on this channel for a while now that this is a buyer's market, and the fact that lenders are now launching products like the ones I'm about to show you tell you that they can see it too. They want first-time buyers in the market. They want to help people get onto the ladder because when first-time buyers move, the whole housing market moves with them. These product launches aren't charity, they are lenders responding to an opportunity and a need. And that's good news for anyone who has been sitting on the sidelines wondering if they'll ever get their chance. So let's go through them one by one. There's been a wave of low deposit and no deposit mortgage products either launched or sitting in the market right now, specifically aimed at first-time buyers. They are quite different from each other, and the right one depends entirely on your circumstances. I am going to do a full analysis video on these separately, but today I'll give you the headlines on each one. Halifax are launching on the 8th of May a £5,000 deposit mortgage. A first-time buyer can purchase a property with just a £5,000 deposit from their own savings. The maximum property value is $300,000 and it's a 5-year fixed rate. No gifted deposits and no new builds. The price cap is the big limitation here, because £300,000 is very restrictive if you're buying in London or the South East. It's a product worth knowing about, but it's not necessarily the right product for everybody, particularly those living down south. Now, Santander's My First Mortgage version requires a minimum deposit of £10,000 but allows borrowing up to £500,000, which is more realistic for this part of the country anyway. They do accept gifted deposits, which Halifax don't, and both applicants on a joint application must be first-time buyers. There's no new builds allowed, no flats, and this one is available right now. Moving on, Accord are part of the Yorkshire Building Society, and their £5,000 deposit product goes up to £500,000 as a purchase price with a 99% loan to value. They accept gifted deposits from family members and flats are eligible. The loan to income cap is at 4.49 times your income. Moving on, we then come to Skipton's track record mortgage, which is a completely different concept. No deposit at all, 100% loan to value, but instead of needing savings, you need to evidence 12 consecutive months of rental payments within the last 18 months. They're essentially saying that if you can pay rent, you can pay a mortgage. Now, maximum borrowing is £600,000. New builds are accepted, which none of the others allow. It's good for renters who simply can't save because rent is eating all their income. This one is a genuinely life-changing opportunity. And then we've got April mortgages with a no deposit scheme. They're doing something structurally different. No deposit, 100% loan to value, but on a 10 or 15-year fixed rate rather than a standard 5-year fixed rate. The part that I really like though is that as your loan to value improves over time, your rate automatically reduces. So you're not locked into an expensive rate forever. You're on a path downwards as you build equity. Strong credit history and stable income are essential for this one. So that's 5 products, 5 different approaches. Some need savings, one needs rental history, one rewards you for building equity over time. The common thread is that lenders are genuinely trying to help first-time buyers onto the property ladder, and I think that's a good thing. Now, I know some people will say this will just push property prices up. More buyers with access to finance means more demand, and more demand means higher prices. I understand that argument, but I don't think it holds up here. These products are relatively niche. They come with strict eligibility criteria, and the volumes involved aren't going to move the needle on national house prices. What they will do is open a door for people who are genuinely ready to buy, but have been locked out by the deposit barrier. The other concern that I hear is negative equity. If you're borrowing at 99 or 100% loan to value and prices fall, you could end up owing more than your home is worth. That's a real risk and I won't dismiss it. But these are long-term products for people buying a home to live in, not investors looking for a quick return. If you're planning to stay in your property for the medium to long term, short-term fluctuations in value simply don't affect you in any practical way. Negative equity only becomes a real problem if you need to sell or remortgage at the wrong time. For someone settled in their home and paying their mortgage each month, it's just a number on paper, not a crisis. I'll go into much more detail on all 5 of these schemes in a dedicated video coming out soon, so keep an eye out for that. But in the meantime, I'd love to hear your thoughts on these products. Do you think they're a good or bad idea? Let me know in the comments. So what does all this mean for you? Well, if you're on a fixed rate coming to an end in the next 3 to 6 months, start looking now. Swap rates are elevated, and while some lenders are still cutting, the political and market uncertainty could push rates higher before they come back down. Getting ahead of it gives you options. If you're a first-time buyer and you've been told that you can't get on the ladder without a big deposit, please do speak to a broker before you give up, because the products that I've just described show that the landscape has genuinely changed. And if you're a landlord eyeing the Mortgage Works rate cuts this week, that's worth a conversation too. So what's my view on all of this? Well, the GDP figures yesterday are genuinely encouraging. The economy is in better shape than the narrative sometimes suggests, but the gilt market is telling a different story because it's driven by political noise rather than economic fundamentals. I expect things will settle, but in the short term, it's about keeping an eye on swap rates and mortgage pricing because it's higher than the economic data alone would justify. My view is that rates should eventually come down, but not in a straight line, and probably more slowly than some of the more optimistic forecasts out there suggest. Who can benefit most right now? Well, first-time buyers with limited deposits. There have genuinely never been more options available to you than right now. Reach out and explore what's possible. And existing borrowers coming off fixed rates in the next 6 months, don't leave it too late to review your options because there's a lot of uncertainty. So that's it from me this week. Thank you so much for watching. If you found this useful, please do subscribe, share it with anyone who you think would benefit, and I'll see you next week. Take care.